What's going on, guys? Welcome back to another video. In this video, I've got another AMC weekend update to bring all of you this afternoon. So the main topic of this video is going to be margin calls. So as you guys know, if you have been watching my channel over the past couple of months, we have been talking about all of the economic indicators that are suggesting that a major correction is coming. One of those indicators is margin debt outstanding in the United States at the current time. This number is continuously increasing, and we have actually also gotten some word from the Fed that basically tells us that the hedge funds leverage metrics are over their historical averages. So if the margin calls have not already started as of yet, and this may not even have to do with directly an over leveraged AMC short position, but again, the entire market does play into the AMC and GameStop short squeeze situations. But if we have not seen these margin calls yet, they are definitely coming in the near future. So we also have to go over this next week coming up. We have a big monthly options expiration date that I want to go over with you guys. And AMC has a really strong possibility to break even more records in terms of their pandemic box office numbers. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people as possible. And if you want to see more videos like this, make sure you hit that subscribe button. So on Friday, AMC closed at $46.19, and in the after hours trading period went up about 4 cents, 0.09% to $46.23. So we are at the lows, and this gives us an opportunity to see some more buying volume push the stock up over the next week. And if we are able to knock it out of the park this weekend with the UFC fight being shown in AMC theaters and Black Widow coming out, which we're going to go over at the later part of this video, that is going to be a great fundamental catalyst for us. So a quick Ortex update. Yesterday, the short interest went up about 0.45% for AMC, and we are currently sitting at 19.06% short interest as a percentage of the free float. Now, I know a lot of people get really excited about gamma squeezes and these monthly options expiration dates, and when we come over to Stonko Tracker, this is going to be tracking all of the call options and put options that are in the money at the current time and out of the money. So right here for next week, we have July 16th is the monthly options expiration date. And right now, 77,680 call options are in the money. Now, a lot of people have been asking me about the amount of contracts that are out of the money, and they're saying, hey, STV, what if those contracts end up running in the money? Could we potentially see a gamma squeeze? Now, the answer is yes. The issue is that all of these contracts are heavily concentrated at the super deep out of the money side for the option chain. So a lot of these contracts are concentrated at the 145, the 130, 125, 120, 110, and there is a lot at 70, so we would need to see a significant price movement to the upside for AMC to see that buying volume get pushed into the market from the institutions. That would need to cover the contracts that they sold. So options are incredibly risky. Always trade with an amount that you are willing to lose, because options are one of the most risky things that you can trade. But again, nothing in these videos is financial advice. These are for educational and entertainment purposes only. Now let's get into this margin call situation. But before we get into that, I really want you guys to understand exactly what I'm referring to when I talk about a margin call. When you are issued a margin call, or an institution is issued a margin call, that does not mean that they have to close out their position, or in this case with AMC, that would mean that they would need to cover their shorts and buy back their shares. That's not what that means. A margin call, you have a couple of options. You can actually put more securities into your account that qualify as collateral, more cash as collateral into your account, or you can close your position. So here is what we are talking about with these margin calls. When the margin calls either have started to happen or are going to happen in the near future, it's going to drain the hedge funds of liquidity. Now, I believe that a lot of these different institutions have been continuously getting margin called just because of the data that we are going to be looking at right now. So when we come over here, this is going to be a tweet from Walter Bloomberg, definitely a good source of good information on Twitter if you guys do not follow him already. Fed report, most measures of hedge fund leverage are now above their historical averages. we have been talking about this on this channel for basically the last 2 months, and we have been pulling up this one chart to really illustrate this. When we come over here, this is going to be the margin debt in the United States right now versus the S&P 500, and this chart right here is inverted. We went over this on the live stream last night, but I need you guys to understand exactly what is going on here. So the margin debt right now reflected in red, we can see that it is approaching $900 billion. Now, for a brief kind of reflection of this, we can see that in 2007, right before one of the greatest financial crashes of all time, we saw the margin get a little bit over $500 billion. Right now, it's almost $900 billion. So we are headed towards a massive over-leveraged situation. So when you think about these hedge funds being over-leveraged, what happens? They get these margin calls. They need to put in more liquidity into their accounts in order to maintain their positions. Now, also, you have to think about what has happened over the last year. After the crash in March, we saw a massive rally in the market. We saw the Fed basically pumping money in left and right. And if anybody was buying the dip in March, April, or May, you were making money hand over fist. So most likely, a lot of these funds still have a lot of money in these accounts, a big gain, so they can basically use that gain as collateral, and they can basically siphon off liquidity from their other positions in order to maintain these margin requirements on their other over-leveraged positions. But what is really important to note is that that cannot go on forever. We have seen the margin debt continuously increase. AMC also continuously increase. So those shorts are losing money by the day, and eventually they are not going to be able to siphon off enough liquidity, and they are going to have to be forcefully liquidated out of these positions. But again, as we say every single time, we do not know when AMC is going to take off or how high the price is going to go. I believe that the price can go as high as it wants to. This is an unprecedented situation, and we really just have to be patient and wait and see how this all plays out. Now, if this chart isn't enough for you to basically say, hey, everybody is massively over leveraged at the current time, the market is basically teetering on the edge of a cliff. If something happens, a lot of these institutions are going to be royally screwed. We also have another indicator that we have been bringing up on this channel over the past week, the 10-year treasury. So we have seen basically since the end of last year, the 10-year treasury yield has been continuously going up. That is a sign of economic recovery. But a couple of months ago, we saw an inflection point at these highs, and the 10-year treasury has been steadily decreasing from this 1.7% range, 1.8% range. It is now at about 1.361. Now, when the 10-year treasury goes down, this signifies that investors in big money are going risk off. They want to be more risk averse, and what they do is they liquidate positions out of equities, which are stocks, and put them into safer investments like bonds. So the 10-year treasury is telling us a really interesting story, and if the margin debt chart was not enough proof for you, the 10-year treasury was not enough proof for you either. We also have Wells Fargo basically canceling their portfolio line of credit program. Now, when you think about how that program works, the loans that are based on the value of their portfolio are exactly that. The loan is based upon the value of the portfolio. So the portfolio of stocks, bonds, whatever it is, are put up essentially as collateral. Now, the percentage that you can actually put up typically with equities is pretty low, to either 20 or 30% of the value of your portfolio. That's what you can get a loan against. But the fact that Wells Fargo is saying, hey, we are going to cancel this program in September, we are closing all of these lines of credit, it suggests that they think the collateral that is backing these loans is going to take a significant hit, and the actual value of these portfolios is going to significantly decrease, putting those loans underwater. So there are a lot of signs coming right now that the market is really not in a good spot, and I believe that is really good for these short squeeze situations, because if we see a significant correction in the markets, or we see the AMC or GameStop short squeeze kick off, it really is a chicken or the egg situation, whichever one comes first. If the market sells off first, we're going to see forced liquidations of positions, margin calls left and right, and the big institutions that are wildly over leveraged that we know are wildly overleveraged at the current time, according to this margin debt chart right here, are going to have to liquidate a lot of their positions. Now, if the AMC and GameStop short squeeze situations take off first, then again, there's going to be margin calls, forced liquidations of positions, maybe in the blue chips, the larger indexes, and those are going to sell off as well. And it's just going to be a domino effect. So we have a lot of very interesting things to look forward to, even though we have not seen the price of AMC do maybe what we wanted it to over the last week. Now, in addition to this weekend for AMC is really big. We have Black Widow coming out, which is a really big deal. So this movie has been really widely anticipated to be a really big hit at the box office. So it spun $39.5 million on Friday, a pandemic opening record. Remember what happened the last times we had a pandemic opening record? The last couple of times we saw this, we saw a significant price movement in AMC the following couple of days. So we also have the McGregor-Poirier fight happening tonight, and that is being shown in AMC theaters for $25 versus buying it and staying at home for $70. Now, I have heard some anecdotal stories that you can't even get tickets to this fight at the AMC theaters anymore, which signifies to me that it's doing really well. So we have a lot of good catalysts coming up for AMC, fundamentally and with the broader market. So that is going to wrap up this update for AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great weekend, and I'll see you guys in the next video.